Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 272nd VideoCast podcast for the week ending January 2nd, 2025. Happy New Year, everyone. We're going to have a great one this year. Very excited about the reasons why, which we're going to share with you in this podcast. But as always, family first. That's Caitlin and I headed out for New Year's Eve in California for the first time. That's the first Christmas tree. It's funny, in Connecticut for 15 years we had a fake Christmas tree, and now we're in California and we have a real Christmas tree. Go figure. That's me and the kids reloading some vans in Costa Mesa this week. Reloaded on the lowlands, which I love. I've got 3 pairs of those now. They went with the more classic styles. This was very interesting, this post. This is a famous breakfast place in Orange County called Sugar Shack, right near the beach. And I thought the headline was very interesting. It said, "Popular downtown cafe's secret to success is not changing with the times." And it reminds me a lot of Warren Buffett buying durable, cash flowing businesses through different cycles that have durable moats. And we'll talk a little bit about that, because oftentimes when the shiny objects are having their day in the sun, it's very, very easy to get distracted. But like Icarus, who flew too close to the sun, they come crashing down, and they come crashing down hard. And we're going to talk about that. Not any crashes or anything like that, but just some data over 120-something years that's going to help you understand the perspective and the framework that we have and why we have it. That was at the party at the new club. Caitlin looking ravishing as always. That was the family. On Christmas, we went out to dinner at this hotel right on the beach, which was pretty awesome. That's Caitlin's dad, my father-in-law, Steve. There's the Caitlin and the girls again, and that's just us going out to sushi the other night. So fun stuff. On to the media. Want to thank Preston Mizell and Christian Dagger for having me on Varney Co. Earlier this week. And this is a very, very important segment with Ash Webster, who was in for Stuart Varney, on some of the historical data that we're going to really drill down on today. So we're going to listen here.
For these markets, Thomas Hayes joins me now. And Thomas, okay, so we had a bit of a sell-off yesterday, but do you have any concerns about losing any momentum going into 2025?
Well, Ash, have no fear. The broadening rally will reappear. I think we saw a similar situation in 2016, right after Donald Trump was elected the first time. You saw some volatility in November, December. The dollar rallied, yields rallied. But shortly right after the turn of the calendar and after the inauguration, everything fell into place. And if you keep it in mind, earnings growth, price is what you pay, value is what you get. The Magnificent Seven, while they're going to grow earnings 21% next year, that is down from 33% this year. Whereas if you look at some of the broadening, look at small caps, for instance, they're also going to grow earnings 21%, except that is up from 8% this year. So one, you're paying 33 times earnings, one, you're paying 15 times earnings. Price is what you pay, value is what you get. So that broadening rally that started in July, we're going to see a continuation of that in 2025, despite the abrupt interruption in December. Expect that trend to resume after the calendar turns, Ash.
Yeah. The Santa rally has been a big belly flop, has it not? I've got 1 minute left, Thomas. A record $1 trillion was invested into ETFs this year. Do you expect that trend to continue?
Well, the last peak of passive ETFs inflows was 2021, which implies it often happens at the exact wrong time. I think what you're going to see is the weights that make up those passive indices are going to underperform the Mag 7 versus the rest of the market broadening start to outperform. As a matter of fact, value has outperformed growth by 4.4% per year since 1927. The only exception, which is why we're stuck with recency bias, the only exception was the zero interest rate policy decade since 2010. So unless you believe we're going back to zero interest rate policy, you want to add some cheaper value into your portfolio as the calendar turns, Ash.
Terrific advice. We'll have to leave it there. But Thomas, thank you so much for joining us today.
Thanks for having me.
And we're back. And then on Friday, I had the pleasure to join Brad Smith and Brian Sazi on Yahoo Finance, going into the last shall be first theme for 2025. I want to thank Justin Oliver and Kayla Hawkins for having me on. We're going to listen in here.
The healthcare and materials sectors are two of the worst performing sectors on the S&P 500 in 2024. Our next guest says now, though, is the perfect time to take a look at what to expect from them in 2025. Thomas Hayes, Great Hill Capital Chairman and Managing Member, joins us now. Happy holidays to you. Thanks so much for hopping on Yahoo Finance with us. So you're banking on a bounce back here potentially with these two sectors. Why is that?
Yeah, Brad, thank you for having me. I think the theme for 2025 is going to be the last shall be first. If you look at healthcare, it's up basically 3-4% year to date relative to the S&P, some 25%. And with materials up 1.8% year to date, very anemic returns. But when the calendar turns, something is going to change, and that's called earnings growth. As a matter of fact, healthcare and materials are in the top 4 earnings growth expected for 2025. Healthcare is expected to grow earnings 20.6%. Materials is going to grow earnings 17.4%, which exceeds the S&P 500 at 14%. And, you know, Brad, if we look at healthcare, there's some strange things happening, but kind of predictable. We saw a similar situation in 2016, right after Donald Trump was elected. Healthcare and biotech sold off. If you remember, he was going to tear up the Affordable Care Act, and the market got nervous. Shortly after the inauguration, healthcare rallied, biotech rallied. As a matter of fact, healthcare was up around 40% in 2017. Biotech around 75% after selling off after the election, and then rallying after the inauguration. I think now it's not the Affordable Care Act, it's RFK Jr.'s got people a little bit on edge. And I think it's a case of sell the rumor, buy the news. It won't be quite as bad as people are expecting on the healthcare front.
What about the materials, Thomas? Good to see you as always. Aren't tariffs going to be bad for this sector?
Yeah, I think it's more than advertised. I think this is a negotiating tactic. If you look at materials, it has the lowest relative performance to the S&P 500 since 2020, and then going all the way back to 2001. These were both generational buy opportunities in the materials sector. And speaking of which, Brian, the materials sector, if you look at XLB, did the exact same thing in 2016. Remember, he ran as the tariff king. They sold off after the election. They rallied in 2017 after the inauguration. So we expect more of the same thing as it relates to just some of the technical stuff on this. You know, materials, only 7% of the components are trading above their 50-day exponential moving average. Now, I'm not a big technician by any stretch of the imagination, but that tells you the sector is completely washed out. And there's one player that we particularly like called Albemarle. It's one of the largest lithium producers. And if you know anything about lithium, it's very cyclical. Right now, it's at very low prices on the fears of a supply glut. We do expect this imbalance to be rectified by the end of 2025. Albemarle is one of the biggest players. They've got $3.4 billion of liquidity to wait it out while the smaller players will be crushed. So we do think Albemarle is going to be a great play. It's also down on the fear of softer, maybe potential or perceived softer demand for EVs in the developed world, like United States, like Europe. However, the EV game is all about China, and that's an unnatural government subsidized market, and that's expected to grow from 40 million stock globally, 41 million stock of EVs globally right now, to 132 million by 2027, largely driven by China and the government subsidies to push that. So that's going to help Albemarle. And even prior to that, you saw Albemarle could perform through all kinds of lithium prices, high prices, low prices, et cetera.
Certainly.
And this time will be no different.
Tom, I got to hustle tomorrow finish here, but just lastly, according to an SEC filing, Warren Buffett's Berkshire bought $28.5 million in VeriSign stock, an internet registry company that's been around since the dot-com boom. You know, Buffett's moves lately, he's sitting on a lot of dry powder. What do you make of that? And how could it be deployed potentially? Where are the top areas he could deploy that in 2025?
So VeriSign is certainly a headline. It's 91 basis points of the entire portfolio. So you can see a lot of these moves are being made by the lieutenants, Todd and Ted. Buffett's got, some $325, $350 billion of cash. I think right now it's about preserving his legacy, going out like Seinfeld at the top of his game versus eking out a few extra percentage points of returns. He's got the greatest investor of all time, in my view. I think he's been cautious. I think there's a Buffett premium on the basis of sometime after he passes, perhaps the sum of the parts is greater than the whole, but Buffett never wanted the company broken up. So that's going to take many years, if ever, to break up. You're going to have to roll off a lot of the current board members before you see that type of makeup, or before you see a material dividend, which is something else people would talk about. So I think right now it's preservation, it's a victory lap. And it's going to effectively, it's the law of large numbers. It's going to effectively trade like an S&P index prospectively, unless they can really hunt down an elephant before his passing and buy a very large, high growth business at a reasonable price, which is not looking like a high probability event in the coming years.
Thomas Hayes, always appreciate the insights. Happy holidays. Talk to you soon.
Thank you. Thanks for having me, Brian and Brad.
All right, all your mark.
And we're back. And then finally, want to thank again Christian Dagger and Preston Mizell for having me on Varney Co. on Thursday to discuss two beaten down sectors where we see tremendous opportunity for 2025. Again, thanks to Ash Webster as well. We'll tune in here.
Let's get back to the markets. Bring in Thomas Hayes, who joins me now. The market's slightly lower, but trying to get back into positive territory. Thomas, you like healthcare and materials. Let's begin with XBI. It's a biotech ETF. Why do you like it?
Well, Ash, I think the theme for 2025 is going to be the last shall be first. And materials has only performed 1.8% up year to date, just 1.8% relative to the S&P, up some 25%. And the expected earnings growth for materials for 2025 is 17.4%. That exceeds the S&P 14%. So I think there's going to be a reversal here. I think there's going to be an opportunity. And we saw a very similar thing in 2016. Right after Donald Trump was elected, materials sold off. Right after he was inaugurated, materials rallied for 2017. And the way we want to express that, Ash, is with a company called Albemarle. And Albemarle is one of the leading lithium providers, and it's really sold off. It's down 72% from its COVID highs, and it's sold off on the basis of a short-term lithium glut, which is very cyclical, and the perception that EV demand is going down, which it's softened in North America and Europe, but China is driving the bus on EV demand because it's an unnatural government-subsidized market, and the stock of EVs is expected to grow from 41 million now to 132 million by 2027. So they'll just cut costs, they'll ride out the short-term glut, and as one of the biggest players with 3.4 billion of liquidity, they'll be just fine.
And Thomas, very quickly, it appears you're pretty bullish on the new year.
I am bullish on the new year. The second group we like is healthcare, which is only up 3.7% year to date. They're going to grow earnings 20%. And the way we're expressing that is through biotech XBI. This is all about deals in drugs, a deregulatory environment with the new administration. The FDA will approve more drugs. The FTC will approve more deals. And pharma needs that innovation. With record cash on the balance sheet, they're going to have to buy that innovation from biotech at near historic low valuations. So there's going to be great opportunities in biotech and healthcare.
I feel I feel the bullishness in the air, Thomas. Thank you so much for joining us. Really good information, Thomas Hayes, on some of the areas you may want to consider in the new year. Talking of the market, let's take a look at...
And we're back. So that's the 30,000-foot view to kind of get things started here. I like to go through some of the extremes so we can get a sense of where we are. You have two schools here. I think a lot of people getting cautious, rightfully so, but we're going to see as we drill through this stuff that they may be justified in getting cautious with the index and indices, and unjustified getting overly cautious on the things that are already beat down with the tremendous opportunity there. So you see the NYSE, you see NASDAQ 1% EMA, advanced decline. That could probably have a little lower to go. But a couple of my favorites I wanted to cover here. Okay, there's a NASDAQ high-low. That's kind of mid-range. NASDAQ up, down volume. Real estate stocks, kind of mid-range. Okay, here's material stocks. Percentage above the 20-day exponential moving average down to 0. That is a buy time. That's what you see when they're absolutely in the gutter. So we have our Albemarle's and so on. We're going to talk a little bit about that. Healthcare stocks, which we talked about with Ash Webster again, and with Brad and Brian. They got down to 5% above their 20-day exponential moving average. These are always dips to buy, not to sell. And nothing's foolproof, but we're in the probabilities business. Dow, intermediate term, breadth momentum, that's getting stretched to the downside. Time to take opportunity. Here's the S&P 500 McClellan Summation Index. Again, towards areas where there's opportunity, could go a little lower for sure. PMO buy all down to 0. That's a percentage of S&P 500 on crossover buy signals. It doesn't really matter what that is. What matters is where it's at, and at 0, the risk rewards are in your favor. Same with PMO by Dow Jones down to 15. Same with PMO by SPX down to 10. This is where you get these awesome opportunities to buy great businesses at a discount. Bullish percent S&P 500, that's pretty extreme. Could potentially go a little lower first because of the weights of some of the tech stocks. You saw Apple down pretty meaningfully today. NASDAQ McClellan Summation Index kind of middle of the range. So the NASDAQ ones probably could push further down, whereas some of the Dow and NYSE and value seem to be in a position where there's opportunity. Let's go into our charts here. I'm going to give us a little bit more size so everyone can see everything. Stocks have done quite well in the first year of a new term lately. This is from Ryan Dietrich. So you can see here the Biden term was up 26% the first year of his term. Trump up 19%. Obama up 29%. Obama up 23%. Bush in 2001 was down 13%, but pretty much everyone until you go all the way back into the 70s when Nixon, Carter, and the first term of Reagan were troublesome, but rates were also 18% in 81, and Volcker was tamping them down. Ryan Dietrich, S&P 500 up about 28 to, okay, we only had an 8.5% peak to trough pullback all year. So you can see how that registers relative to all of the previous years. The average year sees a 14.2% correction, which increases the odds it might happen next year. That is skewed by the years that you have 20 and 30 for sure, but I've been saying we will probably get a 10% correction, a 10 to 15% correction, maybe 1 or 2, and that'll just be opportunities and you just ride them out. But as far as is the bull market over and is everything going to go to hell, the answer is not yet, and not really anytime soon. I do think we'll get some 20% pullback corrections and 25% corrections like 87, like COVID, etc. But I think this is going to run. You've got 12,000 people turning 35 years old every single day in the United States. Those demographics are going to shine for at least another 5, 6, 7, 8 years into the early 2030s where I start to get aggressively worried. But in the meantime, it's buying things with a margin of safety, so I don't have to worry about the short-term pullbacks or rotations or anything else because I know what I own, and when they turn, it comes all at once. So M2 money supply is turning up. That works in our favor. Here's from Seth Golden. As a perma-bear, you're truly awaiting one shiny moment. Average duration of a bear market is 446 days. Average duration of a bull market is 2,069 days. Average bear market is negative 35. Average bull market is plus 209%. If you choose bull, you'll endure any bear market. That's for sure. And what he's showing here is that, basically, also the other thing to keep in mind is this bull market is relatively new in the scheme of we had the 25% correction in 2022, which was a recession too. Everyone waiting for a recession. We just had 2 in 4 years. You usually have 1 in 4 years, so we pulled forward a recession. Very hard to have a recession with 2.5 to 3% GDP growth. So that's off the table, which in theory pretty much takes a 25% correction off the table as well. Even usually a 20% correction, unless you have just some short-term dislocation for a week or something like that. So with the average duration of a bull market is 2,069 days, and we've been going since the fall of 2022 when we were pounding the table. You're basically 700 days in, so you're less than half of the way there, and I think that's a reasonable way to look at it. Santa rally since 2000, we will see. I think tomorrow comes into play. Last year we did not have the Santa rally, and we had a great year, so all that January effect and predicting the future is kind of not terribly useful. Here is Japanese bond yields. And I emphasized aggressively in last week's podcast that the number one thing you need to watch as it relates to the Magnificent Seven is not whether the FTC is coming for them. It's whether the Bank of Japan is unwinding the carry trade knowingly or unknowingly by raising rates to quell rising inflation. And you started to see these rickety wobbliness in Mag 7 in the last handful of sessions, and what that's been coincident with, and I would say causal to, everyone's here saying, oh, it's pension rebalancing and all that, and yes, there is some of that, but watch the JGB yields, because as that Japanese money gets more expensive, the carry trade becomes less profitable. All that free money has been parked in Mag 7. They were getting the benefits of currency, depreciation of the yen, appreciation of the dollar, and stability of Mag 7. As rates go up, that trade becomes less attractive and the money gets out. Hot money like nobody's business. So that is the number one chart you should be looking at every single day when you wake up, is the JGB yields. As yields go up, the odds of Mag 7 holding on to the weightings they have and the flows they have get cut in half very, very quickly. U.S. pensions to sell $21 billion of equities. Okay, so that's the U.S.-centric view of any wobbliness. S&P performance after gaining more than 35% in the last 12 months from October. So you look 1 month out, you have some negative returns. 3 months out, you're up 3%. 6 months out, you're up 3%. And 12 months out, you're up 13.8%. I think that's a reasonable expectation for the indices this year, given expected underperformance of Mag 7, between 8 and 13%, and under the surface making money all day long. Seth Golden, no way to sugarcoat it. First year of Republican-led administration is on average not good for equities. Extremely stark difference from Democrat. Trump 1.0 bucked the trend in 2017. Can it happen again with Tax Act 2.0? We're going to find out really soon. I think on balance, they're going to give him the benefit of the doubt again, and it's going to be an okay year for sure. Maybe not for Mag 7, as Mag 7 did less well under Trump 1.0 on balance, but still did fine. Small cap and large cap earnings estimates into next year. Now, this is the Russell 2000. If you look at small S&P 600, it's a little different. But for Russell 2000, this is from FactSet. They're showing 57% earnings growth for the Russell 2000 small caps versus the S&P 500 of 14 to 15%. That's as of December 10th. If you look at the small cap S&P 600, it's more like 21%. But the fact of the matter is, you pay less, you get more earnings growth for lower multiple, and that's why that rotation, to have no fear, the broadening rally will reappear. We feel very confident in that viewpoint. Halfway through the roaring 20s, S&P performance since the start of the decade. And I think that gives us another 5 years of runway there. CFO optimism is rising. That is a that historically has forward-looking ability, forecasting ability, as that consumer as that CFO optimism rises off despondent lows like we saw in the 2022 and 2020 recessions. Equities tend to follow, and I think this time will be no different. Dollar index after a Trump election. We have emphasized this over and over as everyone's panicked about the 10-year yield and the dollar destroying everything and all the plans with emerging markets and everything else. We said now that Trump has elected, expect this. The same thing happened in 2016 for the month and a half after he was elected. Through to inauguration, the dollar went up, yields went up. After the inauguration, after the turn of the calendar, they all collapsed. Dollar rolled completely over, just like you see in this chart. Same thing with the 10-year yield. Emerging markets rallied, biotech rallied, the whole story. So we're pretty excited about that. And one of the reasons that we are super enthusiastic about 2025 got delayed a couple of months with the election result. We had no way to predict the election winner, nor were we trying. And we wouldn't have changed a thing even if we knew the outcome, because one, it creates unnecessary tax events. Two, you can look at an analog to get a sense of what might happen, but to gamble on it exactly repeating is a fool's errand. That what we have is a beautiful portfolio of amazing businesses that we know everything about in concentrated form. We have a huge margin of safety. We've got turnaround catalysts with CEOs and durable businesses and plans forward. We've got solvency risk removed from pretty much all of them, if not all of them, and the turnaround in place from the destock to the restock cycle. So we couldn't be more excited. We just had to eat 6 weeks of volatility after the election, and now we're going to get the benefit of the rewards, holding tight and using those opportunities to be topping up everywhere we possibly could. It's been a very busy holiday season and super excited. Some of the folks that came in last week after the podcast called, they already got approved. We put a lot of money to work today. We're going to put a lot of money to work in the next few days as more of those applications are approved at Interactive Brokers, and all the existing clients, new clients are going to be beautifully set up early, right before the inauguration, for all these great things to unfold. And then we'll close out sometime well before the inauguration in the next week or two. So here we go. PE ratios. Quartile. So this is from Hulbert Ratings. Mark Hulbert, he writes with data with a pretty much chronically bearish tilt historically, which is good. You want to have the counterbalance of the data. So he'll just find data to support a bearish view pretty consistently over the decades, and he's a well-respected journalist in the industry. So here what he's saying is, we're in the top 92nd percentile in terms of PE ratio, 96th percentile in terms of CAPE, 98th in dividend yield, 100th in price to sales, 100th in price to book. So what he's basically saying is, based on these valuations, we are going to correct and we're going to die. He's had the similar data in each of the last 3 years as well. Maybe this year he'll be right, but I think he'll be right in a concentrated portion of the market. In the areas that we're trafficking, they've really taken out, at some point, it's so cheap to own such a high quality portfolio of assets. At some point, they're almost paying you to take them. It's mind boggling. It really is exciting what this once in 100-year event with COVID created in terms of generational opportunities to buy unbelievable businesses marked down on sale. And, I talk to some of you and they're like, wow, I love your optimism, but it's not optimism. You will find periods in future years where I will sound like David Rosenberg and Mark Wilson's cubed. I'll be the most negative person on the street. It's just not the right time. That's the bottom line. And when that time occurs, we will be there. I'm agnostic to being bullish or bearish. Obviously, you're going to be bullish. You're going to make a lot more money over time being bullish. I've only met, I used to say I never met an extremely wealthy perma pessimist. I do know one, but he's made most of his money selling pessimism versus otherwise. But he's built a great business doing that. But that's the exception, not the rule. On balance, you want to be an optimist. You want to see opportunity. Pessimists look for the difficulty and the opportunity. Optimists look for opportunity and the difficulty, and that's where all the money is. So not only do value and growth rotate over the years, but international versus U.S. This is from Ritholtz. This shows the rotation from international equity outperformance to U.S. equity outperformance. And as you can see, in the zero interest rate policy that began in 2010, what happened from 2010 until ZIRP ended in 2022? U.S. dramatically outperformed international by a level of outperformance that we haven't seen since 1995 to 1999. And then prior to that, 89 to 93. And then prior to that, 79 to 83. But if you look at these cycles, they usually only last 4 years, 4 years, 4 years, 5 years. Here we had this extended cycle of 10 years because of the aberrational zero interest rate policy that favored U.S. stocks, among other things. And if you believe that we are going back to zero interest rate policy, then you should continue to bet exclusively on the U.S. But if you believe that this is a normal cycle and that international could start to outperform like we've seen early signs of the last 2 years, just like we saw early signs of in 2021, 2022, 2001 and 2002, before you had dramatic outperformance from 2003 to 2007, dramatic outperformance from 92 to 95, dramatic outperformance of international from 1983, Reagan 1.0, to 1989, dramatic outperformance from 1976 to 1979, dramatic outperformance of international from 1970 to 1973. So every 4 years. So maybe you could see a situation where if I'm right about the terminal rate and we don't go any lower than 3.5, I think terminal rate's going to be somewhere between 3.5 and 4. Even if we went to 3, but we don't go anywhere near 0, that we could see the next 4 years cycle like early Reagan, where international, like early Bush, where international dramatically outperformed the U.S. And what does that mean? It means the top 10 stocks that make up 40% of the index start to materially underperform, and I think that is coming. A historic boom in immigration, average annual change in foreign-born population as a share of the total U.S. population. So we added 2 million in the last 3 years. That is the highest since the 1850s. So that's that. At least we're still getting population growth. We can debate what type of population growth is best, but we can't debate that we need population growth. So I'll leave it at that. putting 2024 in perspective. So again, the average pullback around 14%. It's been anemic. We did have a big one in 2022. We had a big one in 2020, a big one in 2018. So you see all this stuff, but actually in 2016, 2017, 2019. So that's that. Monthly return stats for the S&P 500 since 1964. January is a good month. It is positive 58% of the time with the average return of 1.1%. What are the worst ones? I think everyone kind of knows. September's the worst month. February's one of the worst months. August. So on balance, you get cautious if things are really hot into August, September. On balance, you get cautious if things are really hot through January. February tends to be a little bit rocky before picking up in March and April, before the sell and may go away, and then things turn up after September, mid-October. But January on balance tends to be A-okay. Small cap fundamental tailwind. Again, this is just re-emphasizing the earnings growth that we've talked about. Small caps in blue, relative big earnings growth. I guess this is the Russell again, talking about 42% earnings growth, 30% earnings growth, 53% earnings growth, 60% earnings growth, 49 quarter by quarter. That's the Russell 2000. That's a little skewed by the percentage of companies that are not earning. That's why I've been going by the small cap 600, which has a higher percentage of earning companies, which is 21% earnings growth. But at the end of the day, you're still paying 15, 16 times versus 23, 22, 23 times for 14% growth for the regular indices. Net integration has already fallen. Solid real income growth should remain a key pillar of consumer spending growth. That's from Goldman Sachs. We expect GDP growth of 2.4% in 2025 to beat the consensus forecast of 2.0, supported by solid private domestic demand growth. That's from Goldman Sachs. Here's the seasonality since the last 20 years. December, you tend to get a little bit of rockiness. At the end, a little bump up early January, mid-January week. Let's see here. And then strong into the end of January, week in February, as we discussed. Straight up into May, a little rockiness. Strong into July, week in August, September, and then straight up. So it's just good to have these roadmaps. It doesn't mean they repeat, but there's a tendency to rhyme. And if you know the lay of the land, it puts you ahead of the pack. Record dividend outflows to add pressures to currency. This is dividends paid by Hong Kong listed Chinese firms. We'll talk about that. I think the big story is the Chinese are doing the exact same thing they did in 2016, which is devalue their currency ahead of the trade war. So it's a net zero effect to them because they manipulated their currency downward. So if he adds tariffs, because of their weakened currency, it will have no inflationary effect. Therefore, it won't affect the volume for them, and they win. And it hurts the U.S. because the dollar is stronger and makes it harder for us to export things globally. So that's what's going on there. And then after the sell the rumors there, buy the news when it's less bad than advertised. Then they can normalize the currency and everything rock and rolls. And you see BABA that time, 2016. We'll just show you again for the newer listeners. After it sold off following the election, you had a basic doubling in the next year. Get that back up and get that back up. There we go. I'm back. Just got to move that around so I can get this and show you guys a preview of coming attractions. So here was Baba. Big sell-off after the election, dropped from looks like about 100 down to 84. Not dissimilar from what we just saw. And then after the turn of the calendar, and certainly after the inauguration, you saw big strength. Went from $84 a share to $187 a share in 11 months. Doesn't mean it's going to repeat, but I would anticipate it's going to somewhat rhyme. Baba was up 10% for the year this year, moving in the right direction, but it's time to get paid. It's time for clients to get a huge payday, and existing clients, new clients, and get monster IRR inside of 12 months, and that's how it works. I mean, for the strategy, for a mean reversion strategy, you wait and you wait, and then you get just monstrous amounts of stuff all at once, and then you do this exact same thing. You reinvest, you wait, and then you get another monstrous amount. And I've been doing this for a long, long time. And when you have a portfolio that has zero correlation to the general indices, unlike many active managers that are just closet indexers collecting fees, whether it goes up or down, but actually doing work and buying great businesses that you would want to own the whole thing, and then you wait for the market to realize what you see. It's like Christmas for those periods. You can make literally a decade's worth of money in 1 year when you get these things all coming together at once. So this is what we saw in Trump, and here was K-Web, same story, doubled. Equal weight did well. Just all this stuff, all this nonsense after the election. Solar stocks almost doubled after a disaster sell-off before the inauguration. Biotech, same story, and then off to the races. The only thing that did really terribly was energy stocks, but I'm not sure that will be the case. I think some of the servicers can do okay. Materials, same story. So look, we've gone through this. I just wanted to reemphasize that for new people, and understand I'm enthusiastic for a reason, not to be enthusiastic. I can be more pessimistic than anyone in the room. When it's time to be more pessimistic than anyone in the room, I don't think it's time. If I was fully concentrated in Mag 7, I'd be a little bit nervous. I got to be honest with you. I'd be very nervous. Not because I think they're going to crash, not because I don't think the businesses are awesome, not because I don't believe in AI. I do. I use it. But the future that the market prices instantaneously often takes a lot longer to play out than anticipated. So the markets tend to think it's going to be 3 to 5 years. The reality is it's usually 15 to 20, but the market's right. Except that the bag holders that buy the 3 to 5 year story wind up with the 80% drawdowns. And even though they got the long-term thesis 100% correct, they paid for the long-term thesis being fulfilled in the present, and it was going to take 20 years to happen, and they thought it was going to take 3 years. So that's all I'm saying. Bull and bear markets, this shows MSCI World. This is just a different way of showing the underperformance versus the outperformance by JP Morgan. International is due, value is due, etc. Regional earnings expectations, you can see China for next year is going to grow about double digits. It's trading at single digits. Emerging markets at 13-14%, US at 13-14%. The difference is for US you pay 23-24 times. For US for emerging markets, and certainly for China, you pay high single digits for similar earnings growth. World going to grow 12%, and you're paying a third less multiple for that earnings growth. U.S. equity market faces unprecedented concentration at the top. Top 8 stocks 35.7, last highest concentration 2000. So I continue to just remind you of this. I'm not calling for a 2000 tech wreck. I don't think that's happening because they have earnings power. I'm calling for a de-rating of multiples in those baskets that are frothy. while exposure to commodity sectors is near low. So we have our Albemarle, we have our Comstock. Thank you for all the kind tweets over the week. Many of you have doubled your money on that. And we think that's just getting started, but kudos to those who took chips off the table. Doubles are good things, and congratulations. Long-only exposure to financials increased, but still light versus history, so that's turning up. We continue to look for opportunities to get back in, but we have we took a lot of profits in Citi and BAC over the summer. They haven't gone up much since, so that was basically dead money, which was the right thing for us to do, to take that off and buy things that were cheaper. But we'll look for opportunities. We still have exposure through PayPal, which is up, went from whatever it was, 60 to 90, but that's pulling back a little bit. We're going to stay with that for a while. Market breadth, bad breath returns. Monthly market breadth is on pace to hit an all-time low in December. This was a big deal, ladies and gentlemen, and you haven't seen this bad of market breadth since the top of the 2000 tech wreck, which is why I would be very concerned if I was in just indices or instruments or single stocks that are concentrated and correlated, or actually the Mag 7. It just doesn't bode well when you have that extreme weighting. Everyone's crowded into it, and you're not going back to a zero interest rate policy environment. You can play again. You can bet against the odds, and maybe you get another year where you're right. But I always just bet with the odds and do it with low leverage, and sooner or later it turns out, and we mean revert. And then when it turns, it's just like overnight riches. It's exciting, but we're not there yet. But I think we're very, very, very close. Earnings growth is expected to broaden in 2025, arguing for a broader rally. We agree. So last year, it was somewhat justified. 36% earnings growth for the Mag 7, 4% for the rest of the index. This year, 19% for the Mag 7, but you're paying 34 times versus 13% for the rest of the market, which you're only paying 18 times. There you go, ladies. Price is what you pay. Value is what you get. Gentlemen as well. Number of stocks shrinking since the late 1990s. This is exciting. This means there's less supply for more money chasing it. Don't worry. Wall Street knows how to feed the ducks when they're quacking. You will see a ton of IPOs in the next couple of years. That does not mark a quote-unquote top. I'd be a little bit more cautious in 2026 and certainly 2027. But as far as like a secular, everyone's screwed, 2009 or 2000 or 73, I think that's 5, 6, 7, 8 years off. Hedge fund positioning. This shows exposure to cyclicals versus defensives is at a record low. Their tendency is to be wrong. So you want to take the other side, which is more cyclicals, which are being given away right now. The longest and shortest sectors, basically energy is the most shorted sector right now, which is why we continue, despite having exposure through Comstock, which has been amazing. Look for more opportunities. I think we're going to probably wind up having to buy a servicer, but it may not be a full position. Materials is an easier one to get more excited about. Second most shorted. A lot of opportunities to do there. We've got Albemarle. Maybe we'll get more. But the problem is the other thing is not only were we not correlated with the indices, but we don't like to place too many bets that are effectively the same bet. So, you look at some of the Dow chemicals, you look at some of the chemical stocks relative to Albemarle. We want to get more exposure, but we have to be careful that we don't wind up with too much weighting in what is effectively the same trade. And then the least shorted is healthcare and staples. So we'll keep an eye on that. Super micro, most shorted stock. Walmart is the least shorted stock. That's interesting and not really useful information. Here are the most highest net exposure by hedge funds. Lowest net exposure. So none of them want Brown-Forman, Albemarle, Pool Corp, Charter. So here's your buy list. Hershey, Moderna. None of these I'm pounding the table, but they're ones that I would definitely pay attention to. Southwest, Chevron. Okay, so that's that. Long only funds exposure to cyclical versus defensive, also at all-time lows. Last time that happened was 2015, right before Trump was in, and what outperformed cyclicals after Trump got elected. So there you go. I mean, again, these things, you just have to be observant. You don't have to be a genius. You literally just have to pay attention and understand, live through enough cycles and have enough experience to say, yeah, odds are in my favor. I can't guarantee it. I mean, I don't have a crystal ball, but when things are lined up like that, that's how you can outperform over time, is doing what the crowd's not doing and just doing it with low leverage. So if you're, quote, wrong, or what idiots say, traders, day traders that live in their mom's basement, early is wrong, to have this fantasy that you're going to time it perfectly, all you need to do is buy a quality business with a large enough margin of safety. Hopefully there's a catalyst you can see that it happens sooner rather than later, because IRR matters. But if you have a basket of 8 or 12, some happen very, very quick. Some take a little bit longer, but on balance, you're going to do just fine. And the thing about it is, it's not going to be linear. It's not going to be, every year a stair step up when you're doing uncorrelated business. It's like you grind, and then you have these years that are just boom. I mean, it's just literally off the charts. So you have to be accepting of that. Some people want to every week make money or every month make money, and then after a couple of years they give it all back to the casino. Have fun with that. But if you buy businesses and you do private equity in the public markets, you'd be willing to buy the whole business. It's just an awesome way to live. That's all I can tell you. Last 3 months, long only's added exposure to financials, chased them up. Decreased exposure to energy, sold in the hole. So that's why, we've got to consider looking for more opportunity in energy, despite having a good position, continuing to be alert for an asymmetric opportunity. And that's the problem. I'm just not finding asymmetric where I can make multiples of my money, not get into it because I can make a 20 or 40% punt. I'm not interested in that. Which is why I was so pissed when they were going to sell GXO at 60 or 70 bucks. I didn't get in for 60 or 70 bucks. I got in for 100 minimum, and it could be a lot more if they continue to execute, which we're going to talk about today. Most crowded stock in each sector. Like, this is really valuable stuff. I love this stuff. I mean, we'll be here for 6 hours if I go through all this, which I'm perfectly happy to do, but some of you have other things to do, and I don't want your two-mile walk to turn into a 20-mile walk, and you wind up in another state. So hedge funds have decreased exposure to staples this year. I think there's some opportunities popping up in staples, believe it or not. All styles are underweight staples, so that's where some opportunity is. You look at the Hershey's, you look at, to a lesser extent, at Coca-Cola. You look at some of these. I'm seeing staples pop up. Which means rates are going down, by the way. I know no one believes that. We're going to 5%. We're not. Hang in there, ladies and gentlemen. Long-only hedge fund exposure to energy is low versus history. Decreased exposure to materials, of course. That's where the opportunity is now. Underweight real estate. All styles are underweight real estate. Sustained value run. Why? Okay, so this is Sagarita. I'm getting her name wrong, but you know who she is. She's wonderful. She's always on the networks, Fox Business, CNBC. She's a strategist at Bank of America. So she's saying large cap value is the best hedge against duration risk. Cheap stocks outperform when profits pick up with expectations limited to periods of negative risk premia. After a decade of capital driving consolidation and balance sheet repair, the Russell 1000 Value Index quality is neck and neck with growth. Statistics favor value, cheap, neglected, no concentration risk, high PE dispersion, but this has been true for a while. Of course, it doesn't work till it works. How does it not work? You return to zero interest rate policy, which we're not going to do. That implies a depression. No growth, no inflation. Value, very unlikely under Trump. Value and growth now neck and neck in terms of quality. Value stocks remain competitively priced versus credit. 84% stocks. 84% of stocks in the Russell 1000 Value Index offer excess earnings yields, i.e. EPS yield minus 10-year real treasury yield above investment grade bond spread. This is what I talked about with Ash Webster. Value did not work during zero interest rate policy. That was really the exception to the rule, ladies and gentlemen, and we're going to get into some data in just a second. On average, value outperforms growth by 4.4%. In the last decade, if you ask 50 people on the street what does better over time, growth or value, 49 out of 50 are going to say growth, only growth. You got to buy growth. You got to buy growth. AI, man, it's changing the world. 3 years ago it was SaaS. Before that it was Internet of Things. The new flavor of the week. But that is the exception, not the rule. Okay, and the rule is since 1927, value outperforms growth. Buying quality businesses at low prices is how you make a fortune. If you look at the Forbes 400 and all the guys that manage money who are actually on it, there's only one growth manager. It's called Ron Barron, and he had this company called Tesla that he bet on in the early days and he stuck with, and it made unbelievable returns. He's the only growth manager that I've ever seen that had durable performance over time. And if you look at the growth managers who do well, it's usually concentrated in one stock. Live and die. But the guys on the Forbes 400 who manage money, they're all value guys. I mean, that's just the bottom line. So whether it's Buffett, Gabelli, Cooperman, Tepper, Icon, there's a reason for it, ladies and gentlemen. So value trades at an extreme discount to growth on a forward PE. So, if I'm just coming out of school and I just read The Intelligent Investor, I wake up in the morning and I feel like I stepped in, like how lucky can you get? You're in this generational opportunity where value is going to start to dramatically finally outperform growth. It's 2 standard deviations below the long-term mean, the value relative to growth. The last time it got this low was the early 2000s, and then you had a period of 7 years of dramatic outperformance of value versus growth. So, if you're getting into the business in 2010 or 2011 and you were just, 92 and you got the value bug, you had to wait a while until it started to outperform. Last time before 2001, where it was just a generational opportunity to start buying value, was 1981, the beginning of the Reagan administration, after they were taking rates down just like they did in the last 12 months. And then for the next 10 years, value dramatically outperformed. So here we are, ladies and gentlemen, and no one believes it. And that's what it has to be in order for it to be that great. And here on every metric, price versus book, price versus sales, you don't get these relative valuations. You get them once every 20 years, and you got to make hay while the sun shines. And I think the next 6-7 years, we're going to be able to make more money in a shorter period of time than has ever been done in a generation. And that'll be it. And, we'll raise a ton of cash in the early 2030s and, look for some asymmetric bets. But this is going to be the most exciting 5, 6, 7 years for a value investor that I think we've seen in 20 years, 40 years, and then probably before that 60 years when Buffett started his career in the 50s, and you had the same exact setup. And Buffett often acknowledges, I just got lucky when I started. If you believe in this philosophy and framework and you're starting now, either as a client or in the industry, you couldn't be luckier. And so that's that. Price of sales here is value has outperformed growth over the long term. This is juxtaposing that 2000 trough, 2 standard deviation low of relative forward PE of the Russell 1000 value versus the growth indices. So what they're basically saying is we troughed this point here, value versus growth, troughed in 2021. If you remember the peak when you had ARK went parabolic and all these, money losing companies were trading at crazy valuations. That was the absolute peak of the crazy town. That was still ZERP before they started raising rates. And since then, we've started to see the early stages of value starting to come to life in fits and starts. And just like it did in, this would have been 2000 equals 2021 and what's starting to happen, and it's early days, 6+ years. It's going to be awesome. Then you can just see it in the bar chart here. Relative return of growth versus value. And here you go. In the years when value outperforms, it outperforms so big. And that's most years, ladies and gentlemen. I know it's so hard to believe because this right here, this ZERP period that I'm showing you is the exception, not the rule. And because of recency bias, everyone thinks it's the rule and they're going to get slaughtered. I mean, that's just, it's just math. There are laws of there are laws of physics. There are laws of statistics. There are laws of gravity. There are different things. And I'm the most bullish guy. It's a strange thing to be seeing this level of extreme and being so bullish because I'm being selective on where I'm being bullish. The biggest fortunes in the shortest amount of time were made in the 70s, and the general indices from 1968 to 1981 did 0% in price. And that's where Buffett made all his money, Gabelli made all his money, Cooperman made, the whole value mafia made billions of dollars during that period while the indices did nothing. And the Nifty 50 got their asses reamed. And the Nifty 50 back then is the equivalent of the Mag 7 today. The difference was the Nifty 50 was a company called Avon Cosmetics, which just went basically bankrupt, sold to Coty for nothing, Tupperware, IBM, blah, 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 all the high flyers that got smoked and never recovered. So, anyway, you can tell I'm excited, but look at this. Year by year, value outperformed 81, 13%. 82 even, 83 outperformed by 12%, 85 outperformed by 11%. Every year, 5% outperformance, 12%, 9%, 15%, 29% outperformance after the tech peak in 2000. Then you had, look at this. This is crazy. 2000, this was when they put Buffett on the cover and say the old man has lost his touch. I think it was Forbes or Fortune or whatever, because while everyone was buying Global Crossing and Enron, he was buying Coca-Cola and American Express and Bank of America. And in 2000, when everyone was negative, he was positive. And here's what happened. Value outperformed by 29%. 2001, value outperformed by 15%. 2002, it outperformed by 12%. 2004, outperformed by 10%. Outperformed by 2%. Outperformed by 13%. And then zero interest rate policy kicked in, and you had the swing to the pendulum. But if you go back to 1927, this was really the only major exception, except some part of the 60s where you had that level of outperformance during the Nifty 50. Largest 5 stocks represent 27%. You can see here visibly. I'm just trying to make a point, ladies and gentlemen. I hope you're getting it, and I hope you extract value from it because it's important. Accelerating profits growth would historically favor value. Value is greater than growth when profits accelerate. Value performance during the profit cycle, 82 to present. And we're seeing the acceleration right now. Largest 7 S&P stocks trade at a 50% premium. Again, this is reverting. It's the beginning of the reversion. There's a lot more reversion to go, ladies and gentlemen. Just look at these. If you're listening to it, I'd really feel bad for you this week. You should probably take 30 minutes just to get out this block. You can ignore the TV stuff. Just listen to that. But this part's important. More than 1 in 3 Russell 2000 companies is unprofitable. Yeah, and this is presented as it's a bad thing. But if you look at all the periods where small caps dramatically outperformed, they all started like this. Go look at small caps from 2001 to 2007. They all started with the huge percentage unprofitable, and then they absolutely dramatically outperformed. Early 90s, same story. 2010 same story. Mid-caps remain historically inexpensive relative to mega-caps. We've covered that before. Companies tend to outperform after spin-offs. So we've talked about that in the past. Spin-offs generate alpha, so we got to be on alert for more spin-offs. Equal weight S&P 500 trough versus cap-weighted index in July. We talked about that with Ash Webster. The breadth started to broaden. We had an abrupt interruption in December because of the election, because of rates and the dollar, which, again, we know know where the probabilities lie prospectively regarding those instruments that affect everything else. Hedge funds shine during periods of heightened volatility. That's what we are entering with higher rates. U.S. regime indicator improved in November, potentially entering recovery. What does that mean? What is a regime indicator? Well, high quality, low risk, large size. That is what we just came out of. What are we going into, ladies and gentlemen? We just coming out of that. We're going into value, small size, high risk, perceived by turnarounds. Okay, turnarounds are perceived as high risk, which is why no one wants them, because no one actually likes to read past the price chart and actually understand the balance sheet and cash flows and solvency analysis, which is great. I'm glad there's so little competition in that. Otherwise, I'd be out of a job. So that's exciting. So we're moving right into this phase one, and then and so on. So this is just where it's beginning. Dividends historically followed EPS. We expect dividend growth to accelerate to plus 12% in 2025. A lot of dividend stock opportunities. Stanley Black & Decker, Baxter, the whole gamut. Ample room to increase dividend payout ratio is 30% today versus the long-term average of 50%. Look at this. It's all this zero interest rate policy nonsense. This is going to revert back. Dividends should contribute more to total returns than the last decade. The last decade was the exception, not the rule. Historically, from 1936 to 2012, before ZIRP, dividend return was 40% of the total return. Price was only 60%. In ZIRP, zero interest rate policy, dividend return was 16%, price was 84%. That game is changing, ladies and gentlemen. Right-siding long duration growth versus cash return value within the S&P has just begun. Just begun. Dividend yield inexpensive versus history. We love that. We covered that with Ash. This is just a survey of alternative data sources being used. We use some of them. Low PE tops the survey for 9th year running. A forward PE. So this is the metric that most managers are using, which is kind of comical. Europeans use more price to free cash flow. That's interesting. Size increasingly matters. They use target price. No one uses price to sales. Share repurchases, etc. So it's just been a little bit crazy town because of free money. Money is no longer free. People are just waking up to that fact. That the real estate market has figured it out. Now the equities market is starting to figure it out. Quintile, Russell 1000 stocks. What do we have here? Top dividend yield. So you can see here, this is basically a buy list. Baxter International. I mean, there are just a lot of great companies in here to pay attention to. Scott's Miracle-Gro. Nordstrom's getting taken private. Target, maybe. Kenvue is interesting. Staples, no one wants. That's kind of interesting. Gilead's already started to move. Some of the refiners, Pepsi has been beaten down. Medtronic, you can't give away. Healthcare, we like that. So there's just a lot of stuff here. Skyworks is kind of interesting. J&J, Amgen, Mondelez, Cisco, Molson Coors, Kellanova, Avalon Bay. So, yeah. Here is more. What do you got? City there. Newell Brands. Okay, so here's the data on value versus growth. So you can just get a perspective. Historically, value stocks have outperformed growth stocks in the U.S., often by a striking amount. The data covering nearly a century backs up the notion that value stocks, those with lower relative prices have higher expected returns. While disappointing periods emerge from time to time, the principle that lower relative prices lead to higher expected returns remains the same. Value premiums have often shown up quickly and in large magnitudes. For example, in years when value outperformed growth, the average premium was nearly 15%. 15%. On average, value stocks have outperformed growth stocks by 4.4% annually in the US since 1927. So you can't see it or understand it here because of this ZERP aberration, but that's the aberration. The rule is price is what you pay, value what you get. And again, unless you believe we are going back to ZERP, which means a depression, deflation type environment, then you want to be getting some exposure to getting more for the same amount of money. More growth, lower multiple, same money. Wall Street forecasts a bigger increase in earnings for small caps. We covered that. Average small cap returns have been particularly strong when inflation has been 1 to 3%. Periods of rising M&A activity have historically delivered strong equity returns. Particularly, you can see here for small caps and mid caps as well. And then, this is from Seth Golden. Credit card debt rising to new record levels is good. Credit card debt has fallen. So people are saying credit card debt's at record highs. Well, the only time that credit card debt goes down is when you're in a recession. So the last thing you want to root for is credit card balances going down. That's all I can say. What matters is debt service as a percentage of disposable income, and that's near multi-decade lows. Labor markets are fully rebalanced, should continue to see wage and services disinflation. U.S. growth outperformance was driven by outsized increase in productivity. 12,000 people turning 35 every day in the U.S. Here's that market breadth chart again. That is probably the most important one of the week. PBOC, People's Bank of China, steps up liquidity injections via new tools. So they're getting with it. They're just kind of biding their time until the inauguration, and as they did last time. You can see the dramatic underperformance of the Dow in December was just a weird situation. That'll bounce back like a rubber band ball. You're already seeing it today with some of the Mag 7s getting hit, etc. These were the charts that I talked about. PMO buy all at 0. That's usually a time to be buying stuff. SPX buying stuff. National Association of Active Investment Managers down. These are all good signs if you know how to pick stocks. Large gains tend to happen more than you expected. Here's the late 90s. It can go for a number of years, 50s, etc. Chinese government bond yields dropped meaningfully in 2004. Same story before the election, before the inauguration. We expect double-digit returns from most attractively valued global markets. So expected returns in U.S. dollars. U.S. is the lowest. China and Brazil are the highest. This is from Morningstar Investment Management. S&P, after it falls at least 3 consecutive days to end the year, on average, a month later, it's up 6%. So we'll see if that happens. First year of the presidential cycle is usually weak. The exception was Trump. Trump's back, so maybe this will be another exception. We'll find out. 20% yearly gain suggests more green, but don't expect a bigger year than 2023. Average return after these type of gains is 10%. I think that's in the neighborhood of reasonable. This is lining up 2000 to 2021 again, and how value is starting to come back in fits and starts, and will start to scream back sooner than people are expecting. Ex recessions, inflation tends to rise about 6 months after the first Fed cut. We're on track with that. Dollar spot index around election days 2016 and 2024. So again, people are picking up on what we've been saying for months. Not months, after Trump got elected. Dollar is going to go up, then it's going to go down after the inauguration. Same with yields. Tokyo CPI going up, which means JGB's yields will be going up, which means carry trade will be unwinding, which means what? All that hot money is coming out of Mag 7. Inflation in Japan's central capital Inflation in Japan's capital accelerates, keeps rate hike prospects intact. Rate hikes equals unwind carry trade equals unwind Mag 7, or re-rate Mag 7 to lower, more realistic multiples in line with increased CapEx and lower returns on that CapEx. Decelerating return on invested capital. China 10-year government bond yield, same story we covered. China plans record $411 billion special treasury bond issuance next year for fiscal spending. No one's paying attention. S&P 500 members below their 50-day moving average. It's usually an opportunity to buy, not sell, like last October. Dallas Fed manufacturing turning up. We're coming out of the manufacturing depression that we've been in for 3 years. Same story with the Chinese yuan. Devalue before the inauguration. China non-manufacturing PMI is turning up into expansion. No one's paying attention to it. China service activity jumps as stimulus boosts local demand. Monthly market breadth, we covered that in case that wasn't an important enough chart. Public versus private, enterprise value to EBITDA multiples. Here's China automotive sales volume is through the roof. That is good for Albemarle because they're selling, all the EV story is there. People are getting faked out because the demand is decelerating in the developed market for EVs, but accelerating for hybrids. And in China, it's still through the roof because it's an unnatural stimulated market, and that's going to continue. That helps that supply glut in lithium start to normalize over the next 12 to 18 months, and Albemarle has the operating leverage and the staying power with $3.4 billion of liquidity to hockey stick as a result. Wall Street's predictions for S&P 500 end-of-year targets. The highest is Deutsche Bank at 7,000. The median is 6,600, which implies, 10, 11% gain. We'll see. What extent do you think the Magnificent Seven tech stocks will either be up or down in 2025? We will bucket the answers, so slide as near as possible to your desired answer. So they're expecting the biggest concentration of people are expecting Mag 7 to only be up 0 to 10%, whereas last year they expected it to be up, last December they expected this year to be up 20 to 30%, and they were right. So they're expecting way more subdued returns from Mag 7 this year. Where do you see the 10-year Treasury yields at the end of 2025? The biggest proportion are seeing it between 425 and 450, so lower than here. And another big group is between 375 to 4. I think that's a reasonable range. I think 4 is the right number. What do you think the return of the S&P 500 will be in 2025? This is all from Deutsche Bank, by the way, survey. The vast majority think the biggest, 35% think it's going to be between 5 and 10%. I'm in that group. Last year, the biggest group thought it was going to be between 0 and 5%, and it was much bigger. So we'll see. Maybe they'll actually be right this year. In your opinion, do you think the following are more likely to double or halve in the next big move? Bitcoin and NVIDIA. So in December of 2024, 52% believe that NVIDIA is likely to more likely to have than to double. Last year it was only 41%. 61% believe that Bitcoin is more likely to have. More people thought NVIDIA would double last year, and more people thought that Bitcoin would double last December. So let's see if they're right again this year. S&P intra-year declines, we covered that. That's just another variation of the Dietrich chart. Median 2-week S&P return since 1950. What they're trying to portray here, Goldman Sachs, is that the first half of January tends to be really good. It tends to be up 1.25%. An average year isn't so average. That's from Dietrich. Boy, we brought you more data in a shorter amount of time this week than we ever have and probably ever will. So enjoy it. This is home prices turning down. That's good. Economic surprise index down. Here's a divergence with the 10-year yield. So either the economic surprises need to catch back up or the 10-year yield needs to catch back down. I think it's going to be the latter in the short term. And I think the reason is going to be that companies are going to be guiding down due to the aberrational strength headwind of the US dollar in the fourth quarter. So the surprises are going to be negative, even though the dollar will start turning down, which helps them in forward quarters. We'll start to see this catch down, which means 10-year yields down, which should be good for mortgage rates, which should be good for housing, which you can't give away, which is another area we should be paying attention to. Earnings growth, again, small cap. This is in the Russell 2000 because a lot of them are inflecting from negative to positive, 53%. That's unbelievable. The small cap, 600 again, 21%. Corporate credit spreads, record low. A lot of refinancing going to happen. 10-year returns around the start of Fed cutting cycles. First cut. Okay, so we're below average for treasuries after the first cut, but there's a huge catch up and it's always positive. So you want to be a buyer TLT, not a seller in the intermediate term for sure. Dollar's divergence from fair value. It's excessively valued. It's excessively crowded. It's going to change. I'm optimistic 2025 will be better for me than 2024. Top countries, Indonesia is number 1. 90% of people believe that. Colombia is number 2. 88% of people believe that. China is number 3. 87% of the Chinese believe 2025 is going to be better than 2024 versus the United States, where we're way down on the list. 70% believe that it's going to be better. And Japan, 38% believe. Remember, that was the most crowded trade. It was just hot money, ladies and gentlemen. It's going back to China. Small cap ramp in earnings. We covered that. NASDAQ made a gravestone doji for all of you on a monthly basis. So last time it did that was 2021 before you had the 2022 tech sell-off. So that looks like bad news for people in the Mag 7 and in general indices, and good news for us. However, Sentiment Trader says not always a great signal, good signal sometimes, but here are 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 other times. And top, close to a top, nowhere near a top, close to a top, nowhere near a top. So it's a coin flip. So this doesn't necessarily mean that's going to repeat, but it's something to pay attention to. Small cap earnings growth. Again, here's the Mag 7. Here's the last 10 bubbles. Oil in the early 2000s, NASDAQ in the late 90s, Nikkei in the late 80s, gold in the mid 70s, Nifty 50, which we just discussed, in the 60s. So the Mag 7 is the most stretched out of all of them. Again, I don't see a crash. I see a re-rating in multiples, and I see a new emergence of leadership. The companies that benefit from AI versus the companies creating AI is kind of how I'm thinking about it. We covered that. This is from Fundstrat. S&P down 3 days or more in a row in the last 5 trading days of the year. The median return for January the next year is plus 3.6, Q1 plus 5.2, full year plus 12.4. I think that's well within the realm of possibility. I love that empirical data. Tom Lee, smart guy. Corporate net interest payments near record low levels. Corporate balance sheets are in good shape, ladies and gentlemen. They're going to get even better. Refinancing down in the first half of 2025. The investment bankers are going to be busier than a one-armed paper hanger. Here's the mosaic of returns. We did see emerging markets finally get off the mat. Even BABA was up 10%. But this is pocket change. This is rounding errors. This is nothing compared to what's going to be taking place. Fixed income was the worst. And as you can see, the reason I always show this quilt is because it rotates. And I think we're going to see bonds outperform in 2025. REITs will benefit from that. Developed market equity was towards the lower level. That could bounce back. And then U.S. large cap was at the top. But as you can see, it doesn't stay at the top too long. Last time it was at the top was 2019, and then it dropped big by 2022. And then you had 2000 and... Oh, that's the average. 2013 to 15, and then it dropped. So zero interest rate policy. You have to believe rates are going back to zero to be unequivocally overweight and unworried about being in that concentrated bucket. And I think we're getting close to the end of the data, so we can get on to the article of the week. But I didn't want to miss anything, and I don't think I did. Value versus growth. Again, this hasn't been a better opportunity since 2001. Just reemphasizing, same with equal weight versus to the index. Volatility is the toll we pay to invest. Various declines per year from 1928 to 2023. Per year, on average, you get 7.23% dips. You get 3.45% corrections. You get 1.1 10% correction per year. You get 0.5 15% corrections per year, and you get 0.3 30 basis points of the time. You get a 20% bear market, one every 3.5 years. So this is just part of it. And, you know, the reason private equity and private credit have become so popular is because there's no mark to market. So if you run a pension, you get to stick in these vehicles, which is mark to make believe. And the purveyors of these beautiful instruments that never go down, according to the marks that they take, collect their 2%, whether they're in actuality going up or down, because they're marking it to whatever they want, versus what the actual market is. The public markets tell you what it is, but they don't have to mark to the public markets. And then what happens is you get caught in a cycle, and all of a sudden you are marking to make believe, and you get marked down to zero. And you say, what happened? How did this happen overnight? Because you had no indications along the way of the real market valuing it and giving you regular decisions to make it. All you were looking for was to dampen volatility, which is a guarantee to get all the volatility at once when everyone gets the volatility, and to get smoked. So if you want low volatility because you think you're taking lower risk, let me tell you, you're taking much more risk by entering quote unquote low volatility with perfect smooth mark to markets. Where you want to make your money is in, well, you do whatever you want to do. All of this is opinion, not advice. I've just been to many movies and I know how they end. This fantasy about private credit being beautiful and private equity being beautiful, time will tell. And when the chickens come home to roost, those marks are going to be completely worthless. And the 2% that they extracted, regardless of the returns, is going to prove to be to their benefit, and irrespective of the marks coming down all at once. So that's where it is. I'm not calling for that. I think the economy is going to be strong for the next 5-6 years. So only the egregious actors, but it's coming. So here is sentiment. Again, they're saying it's elevated, but not at extremes. We agree. Bond allocations have been declining since mid-2023. That's when you want to be buying. So that's TLT. Great financial crisis pushed stock allocations below the traditional 60 to 65% band. So while a lot of money's flowing in, it's still relatively low and below average relative to 40 years of history. So there's upside room there. And that's that. All right, on to the news. 2 stock picks for 2025. In 2024's only losing sectors. So they're referring to materials, which we love. They're talking about Dow and LyondellBasell. I think those are 2 worth paying attention to. This is China EV sales set to overtake traditional cars years ahead of the West. That helps Albemarle. That probably also helps Cooper Standard, has been doing a lot of business there. That's just about Doge, so I'm not even going to waste time logging in. China's December home sales stay flat in sign of stabilization. PBOC steps up liquidity injection with new tools at year end. Don't know what that was supposed to be. China's services activity jumps as stimulus lifts local demand. Chinese stocks race past peers for first annual gains since 2020. Beginning of coming attractions, ladies and gentlemen. That's the optimism index, which we covered. U.S. new vehicle sales set to rise 7.3% in December, report says. And thank you to the stupid people who do not know their data and gave us the opportunity to buy a ton more of Cooper Standard today. We love you. We're very grateful. And my newest clients and existing clients with Room will be sending you a Christmas basket next year. Thank you for your generosity selling in the hole to us. Very, very grateful. So basically, they're coming out at a 17.2 million unit annualized SAR in December, ladies and gentlemen. If we had a 17.2 million actual SAR, Cooper Standard, oh my gosh, so 1.4. Gosh, it would just be, I mean, they'd be earning at least $10 a share, that's for sure. So put whatever multiple you want on it. I love 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 it. The Crazy Town lasts, when it changes, it literally changes all at once. But if Crazy Town didn't exist, we wouldn't have these opportunities. So just embrace it and enjoy it. And if you need to go for a walk and go play 18 holes, do it while you wait. Investing pros think that the stock market losers are set to rebound. They're pointing to Albemarle. This is from Jacob Sonnenschein. Good dude. He's always on Varney. And he's a avid reader and follower of our work. And we're grateful for that. Smart dude. Alibaba partners with South Korea's E-Mart to launch e-commerce platform. So they're going after the international like nobody's business. We love it. Holiday spending clearly on track to reach record-breaking heights even as credit card debt strangles shoppers. It's not strangling anyone, Catherine Dunleavy. The debt service as a percentage of disposable income is still near multi-decade lows, but we keep an eye on it. Credit card debt being at record levels, GDP's at record levels, in case you didn't get the memo. So hang in there. Yes, you're seeing some strain at dollar store in the lower end, and that's just part of the thing. But those are the people who did the best under Trump 1.0. So give them a minute to find the coffee machine, and we'll be off to the races. China's record dividend payout intensifies pressure on the yuan. It's not the only reason. AI boom may be too good to be true. This is from Josh Harlan over at the Wall Street Journal. Pending copyright infringement lawsuits could derail the industry's economic potential. Why? Because they're scraping everyone else's data and not paying for it. So when they have to pay for it, it's going to slow the game down a little bit. But who's going to benefit are the companies like GXO and Amazon and companies that can apply AI in their operations and take costs out, which we're going to talk about in GXO. 3 healthcare stocks to buy for 2025 rebound. So interesting. Jacob's talking about materials and healthcare. And the 3 stocks he's talking about here, CVS, Humana, and Cigna. I think in United Health, I think there's going to be ponies in the pile, certainly healthcare. So he's talking about Amgen. Look, he's got healthcare right for sure. How you want to express it is another story, but love that. 2025 5 highest yielding dogs of the Dow could explode higher. So we talked about this a little last week. Was it Chevron, Verizon, Amgen, Johnson & Johnson, Merck? So here are some healthcare stocks that have been beaten down a lot that I think you're not going to get hurt and you might make a lot of money. So that's a good thing to do. Stock bears are going extinct. Time to worry. Time to be alert. Certainly the ones that are blindly pushing into indices and into concentrated areas that I think are going to get some air let out of the balloon. Why the Dow had such a miserable index in miserable December versus other indexes. Yeah, we covered that. You can read the article for the why. Eli Lilly, it's rates in dollar. Drug trial results could shake up pharma stocks in 2025. Watch Eli Lilly, Pfizer, and more. I think Pfizer you got to pay attention to at these levels. Certainly dividend yield is good too. U.S. dollar is riding a high. Trump could put an end to all that. This is from foreign exchange veteran Karthik Sankaran. We agree with Karthik. Jobless claims dropped to 8-month low to end 2024. Low U.S. unemployment fuels economy. Natural gas prices spike on forecasts of colder winter than expected. Amen. Comstock. PBOC seen delaying reserve ratio cut after $233 billion cash injection last month. Waiting till after the inauguration. There's the car volumes. Chinese EV makers BYD, NIO, and Li end 2024 on a sales high. Here's Munger. The wise ones bet heavily when the world offers them that opportunity. They bet big when they have the odds. It's what we've spent the last hour and 23 minutes talking about, the odds in 2025. They bet big when they have the odds, and the rest of the time they don't. It's just that simple. Buffett, you don't have to be smarter than the rest. We just have to be more disciplined than the rest, not succumb to the emotional ups and downs, but actually just know what you own and do it on low leverage, and you just wait for the big paydays, which come all at once. You wait, and then it's jackpot, and then you reinvest. You wait. It's double or triple jackpot. You reinvest. You wait. Quadruple plus jackpot. You reinvest, etc., etc. Ray Dalio, when you think that it's too hard, remember that in the long run, doing things that will make you successful is a lot easier than being unsuccessful. There's no question about that. Article of the week, no value in value? That's a question. So in a year like 2024, it's easy to forget the fact that since 1927, value has outperformed growth by 4.4% per year. We covered this chart. We covered most of these, so we don't have to go through them again. International as well. Covered the TV spot, so that's all good, and we can get right down to business with GXO Logistics update. They had the rumor where they were going to be sold. Stock shot up to from 46 to 63, and then it wasn't going to be sold, and it shot down to 40. Now 41. Now it's 43. But as you can see, the free cash flow is steady and solid. Revenues continue to grow. They had record revenues, record EBITDA. Good organic growth, and price target upgrade by Oppenheimer to $67. It's trading at $43. That's a 12-month price target, and that's after the news about the CMA going to level 2 with regard to the Wincanton acquisition. There are two overhangs on the stock, ladies and gentlemen, so you don't have to analyze the logistics business because they own it. What you need to analyze is, are these two overhangs worth a $20 drop in the stock? And the answer is no. And I'll tell you why. First and foremost, this guy is retiring at 65. Which is a normal retirement age for a public company CEO. Maybe he could go to 67. He had a good run, and you never know why. But 65, if he was 55, I'd be a little worried. So now you've got this whole wait, who's going to be the new CEO? So you're going to have an overhang on the stock. It's not going to do much until they announce who's the new CEO. And knowing Brad Jacobs, who attracts winners, he's going to get a rock star in there, and the stock will be a major catalyst. There's nothing to turn around there. The stock's doing, the performance of the business is doing great, which is why people were unsolicited offering tenders to buy the company. So that's number one. Number two is the referral of Wincanton acquisition to the CMA in the UK after the fact. So they did the deal last March. They are waiting to merge the companies. They're running side-by-side silos. Wincanton has lower margins than GXO, but when they start to operate them as one unit, that's where they're going to get the synergies and dramatically increase the margins of Wincanton, which is a great business, and have an unbelievable business in the UK. Wincanton is concentrated there. So, $750 million deal. 735 million pounds. And so you have to look at what's the worst case scenario. The worst case scenario is the CMA, which is the UK regulator, says you can't do the deal. It's anti-competitive. And if they were going to do that, you would think they would do it before the acquisition, and you think the company would be on track. Now, you could say maybe this guy completely screwed up, and that's why he's forced retired, and there certainly could be that. And that's what the stock is saying to you right now, down $40, down to $40, based on the underlying operations of the business is saying, there's a problem here. What if Wincanton gets unwound? Well, if Wincanton gets unwound, you get your $753 million back on the balance sheet, number one. You go make another acquisition or you invest in the business, which they have a huge, high return on operating return on invested capital of 30+%. So I don't mind them having $750 million on cash. The most likely thing, and the CEO discussed it in the earnings call, which is why we spend so much time on the earnings call, which we're going to go into now, is that it's very normal for these size acquisitions to go into phase 2 with the CMA. They require details. They're trying to make sure it's not going to be a monopoly. Look, it's going to be a great business, and I think they'll have to have some concessions about different things so it doesn't become a monopoly per se. But they'll do that, and it will be a great combination, and everything will be fine. It's just going to delay the synergies by a quarter or two. But the stock price is discounting an unwind of the deal. And if there's no unwind, which is where the probabilities are, then you're going to get a reversion back to 50. And then from there, you're going to get a CEO, maybe 55, and then they're going to continue to perform on their 2027 plan. And then we think it's a double plus. So again, opinion, not advice. Go to Hedge Fund Tips, click on terms. It's right up here. Boom. But we really don't get into anything unless we think it can be a double over a few years. So that's that. You can see the fundamentals continue to perform. Pre-Wincanton, post-Wincanton. And they will continue to perform. So let's cover some of the key things. Their revenue was up 28% year on year. 3% of that was organic growth. The rest was acquisitive. Their sales pipeline increased 30% to $2.4 billion. They signed $750 million of new annualized revenue in the quarter, on track to win a record level of business in 2024. This doesn't even sound like a turnaround, but it's priced like a turnaround, which we love. Highest ever quarterly revenue of $3.2 billion, signed $226 million of new business, seeing demand for e-commerce capacity, long-term structural tailwind, key growth driver for us over the past 5 years. Generated almost $200 million of cash flow from operations, $110 million of free cash flow. And they've got $500 million of cash. If the deal got unwound, they'd have $1.25 billion of cash, net $2.2 billion of net debt, which is very reasonable considering the amount of free cash flow that they're generating. Their guidance, they reaffirmed adjusted EBITDA of 800 to 835 million, call it 283 of earnings. $2.83 of earnings, and free cash flow conversion of 30 to 40%. So highlights we covered. Here's some of the recent wins. You can recognize some of these brands: Zalando, LG, Guess, L'Oreal, Gymshark, Beauty Pie. I don't know what that is. That must be European. New contract wins and outsourcing underpin long-term growth. So they got 29% of their new wins from competitors, 40% from new activity from existing clients, and 31% from outsourcing. Strong cash flow and investment grade balance sheet, which we covered. Number one pure play contract logistics provider, 27 countries of operation, 30% of Fortune 100 companies served, $10 billion in 2023 revenue. That's going up a lot. And so on. So just want to get through some of the key things here. You can see by region, UK is 41% of their business, US is 48%. So It is a play on the recovery in Europe. They've got 8% in the Netherlands, 8% in France, 5% in Spain, 4% in Italy, 6% in others. So this is a beautiful leveraged play on a niche business in a market that we think is going to see great recovery in coming years, and they are going to be the greatest beneficiary of that recovery. Here are some of their other blue chip customers. You can see Bayer, Guess, LVMH, Levi's, L'Oreal, Nike, Pepsi, TJX, Samsung, Kellanova, JD, Heineken, Red Bull, Versace, Boeing, by the way. Boeing, they talked about a large U.S. aerospace company, which they got huge new business. So, it's just an incredible business. By 2027, they're going to do $16 billion of top line, EBITDA of about $1.3 billion, operating return on invested capital of 30%, and adjusted EBITDA CAGR. So organic revenue CAGR 10%. So this thing is just going to be a machine, and you get to those type of levels, minimum double, but then you get multiple re-rating, and that's where you get extra juice that you didn't expect when all the lemmings start to follow in after the double. High conversion of adjusted EBITDA to free cash flow, and you can see the waterfall there. All right, let's get into some of the key highlights from the earnings call transcript that we haven't covered yet. $750 million in new business year to date. We've mentioned that we saw the bottom of the inventory cycle in the fourth quarter of last year. We have been talking about that for a year and a half, that was going to be the bottom. It certainly has proven the destock, restock. As we head into this year's peak, we're seeing inventory levels returning to normal, and demand for e-commerce capacity is accelerating. As commercial activity picks up momentum, our technology differentiation through the deployment of automation and AI is creating a multiplier effect in the efficiencies we deliver to customers on the back of real-world results. We are proud to have been recognized with a Supply Chain Excellence Award for our leadership in warehouse AI by Logistics Manager a few weeks ago, etc. Uptick in e-commerce activity. Tech forward logistics expert. About a third of our new business wins year to date have come from newly outsourced business. Around 40% of our $2.4 billion pipeline is made up of customers looking to outsource for the first time. The acceleration of outsourcing is in part a result of the recovery of e-commerce, and it drives customers to look for a partner with scale, automation, and the ability to manage complexity. GXO is well positioned to capture growth from these trends. GXO has been piloting our first proprietary AI application in select warehouses in the U.S. Our tool streamlines our customers' fulfillment processes by using machine learning to predict SKU demand in the near term. The sheer volume of data analyzed by our tool produces highly accurate forecasts of inventory flows down to the SKU level. These insights enable our operation teams to optimize the layout of the warehouse and match resources with demand. Our initial pilots have far exceeded our expectations, delivering predictive accuracy levels above 90% and productivity improvements of 3 to 4x in stock replenishments, which drive increased capacity of 6 to 8% at no additional cost. We're thrilled with the early success of AI, and we're scaling it across our footprint. AI is going to change the way warehouses are run over the next few years, and our leadership in the space is a key driver of our long-term profitable growth. This is the next phase of the AI story, ladies and gentlemen. Not the people selling chips. It's the regular businesses benefiting and improving profitability and productivity from the employment of that, not a better search engine. That game is, that'll happen, but that's not the key game. So, very strong player in the aerospace. I'm sure aerospace, we're going to do incredibly well in Europe. It's a huge market. Very few competitors will be the new kid on the block, and I think we'll do really well. So here, this analyst asks in the Q&A, what about Wincanton and the potential? Malcolm Wilson, the current CEO, talks about Winkington, and he says, let me cover the Winkington point. And I'll hand you over to Barris in terms of a more detailed aspect on the margins. So with Winkington, clearly, we're reviewing the decisions, the phase one decisions that came across last Friday. So we're reviewing that in detail at the moment. And clearly, as we have on other projects, we're going to be engaging very constructively and collaboratively with the CMA. We're kind of remaining pretty confident that we're going to see a positive outcome to it. It's possible that we'll go to phase two, which they did. And frankly, we are prepared for all the potential outcomes that this might bring. And it is not an uncommon environment, by the way, for a deal of this size to go into phase two. Okay, and then he goes on to talk about excluding Wincanton, we have improved our margin every quarter this year. So, Wincanton will be a drag until they can merge the operations of those, or if it's unwound, margins will actually go back up. When you look at Wincanton's margins, they are lower than ours at the moment, but that is the upside in 2025 and onwards. Then we start integrating the business and we capture the synergies. Okay, not actually uncommon for a deal this size to go into what the CMA class as a phase two type process. It's a much more detailed process, which is good, not bad. And basically, we'll work with the CMA to make some clarification in terms of the different market verticals that exist in the UK. UK is a highly competitive environment. There's no question about that. And as a British guy, I'm probably well equipped to comment on that. It is a highly competitive environment. So our intention is to do some detailed work with the CMA teams over the coming months. I think what that will do is it will help us clarify greatly the situation. And as I mentioned, we're confident that we'll secure a good, satisfactory, positive outcome through the process. One of the things that probably it will involve is where we had planned to commence integration of the two businesses in early January. I think it's fair to say we might see a delay on that process, probably stretching out into the beginning of the second quarter. I don't think beyond that, but that's our expectation at the moment because we have to respect the CMA. They do a really good job, and it's quite correct and proper that we work with them to seek clarification on the points that they've raised. All right, so that is the most important linchpin. That and who they're going to name as the new CEO. And the rest of these amazing business developments you can read on your own. Fear and greed is down to 28. That's not what you see at Tops. Congratulations to all the new clients that came in during our 2024 raises. You could not be better positioned for what we believe will be a highly rewarding year in 2025. This view is based on much of the data we've shared in recent weeks on our podcast VideoCast, as well as our proprietary methods of expressing and executing upon those details on your behalf. We reopened to smaller accounts, 1 million plus again starting last week because we want to be fully positioned as soon as possible before the inauguration based on some of the data we've referenced in our recent podcast VideoCast episodes, and will remain open for the next couple of weeks, but close no later than the inauguration. Congratulations to all of you I had the pleasure of speaking with and onboarding last week after we opened up. We expect your applications to be approved before the end of this week. Some were approved yesterday. That's why we put money to work today. Not yesterday, but earlier in the weekend today, so that we can begin deploying capital immediately to see if you qualify. So you can click there. All this is opinion, not advice. Healthcare earnings, top 30 weights have been revised down 1.30% in the last 60 days. Financials have been revised up 1.17. Economic data we covered. So that's it for the podcast part. Now we're going to go into the question and answer, ask me anything questions. So stick around if you like that part. If not, we'll be back next week, same time, same place. Question 1 comes from Karosh, Euronet, Karosh Fate, Euronet Worldwide might be worth a deeper look. I'm curious what your thoughts are. EEFT. Let's see here. What do they do? Payment and transaction process and distribution solutions for financial institutions, retailers, electronic fund transfer processing, money transfer, ATM stuff. Yeah, look, the numbers look great on this, Karosh. I think it's definitely worth a look. We would not be involved in this because we already have PayPal exposure. We don't want two of similar sector necessarily, but you just have to understand what is their durable advantages, their moat intact, and if so, you probably have a decent situation here. Take a look at the balance sheet. Yeah, I think this is reasonable. Good work. Definitely worth further exploration. Ivor, Barry. Are there any single names you would express to the healthcare through? Where you're expressing through XBI, do you think any individual names look good at the moment? We like Baxter. We own Baxter, and we own XBI. We would look at Pfizer. We'd look at some others, but that's what we own at present. We're not going to own 6 healthcare stocks. When you have a portfolio of 10, 12 companies, you generally only do 1 to maximum 2 per sector. And between XBI and Baxter, we feel we have enough exposure at the moment, but are keeping our mind open. On to the next, Ryan Wang. How concerned are you that GXO's acquisition of Wincanton could get blocked by the UK? It's priced in as if it's already been blocked. So if anything less than blocking happens, the stock goes up. So I'm not worried. What's your opinion on SLX? Seems like steel sector is ready for a bounce. Let's see. I generally don't like steel stocks. They just chronically suck. I don't see what you see, so I'm a pass. Even the companies I look at, like Cliffs, and I keep looking at them, keep doing nothing. They're trading vehicles. They're not businesses you want to own for the long term. Want to get your take on Bill Ackman. This is from Jason Zen. Bill Ackman's recent public awareness campaign on the asymmetric bet that is Fannie Mae and Freddie Mac on the conservatorship being lifted and their stocks potentially being a multi-bagger. It's a special situation, but not necessarily a turnaround. Would love your color on it. Thanks for all you do and provide, Jason. As far as I know, he's owned it since Trump 1.0, and he was doing the same public awareness campaign during the first administration, and Trump never lifted the conservatorship. So maybe he'll do it this time, but if you followed that theory last time, it was dead money. EVVTY. This is from Jared Davis. Evolution AB. Financials look great. I got to understand the business. Online casino systems to gaming operations in Europe. I think someone else brought that up. This tends to be a very... I think this is like international game tech in the U.S. I tend to not like these because they do great until they don't, and then they just blow up for no reason because it's like very cyclical. It looks perfect now financially, but you'd have to do a lot of work on it and just understand how it's going to out-earn the normal cyclicality and the unpredictability of that business. All right. What is your opinion, not advice, check terms on Starbucks and Wynn? We covered both of these. Starbucks was a turnaround. I think it's going to continue to turn around. The issue with both of them is they're, for us, Starbucks didn't really get cheap enough, and I think competition is it's a China play, as is Wynn, and we have enough China exposure through Alibaba, so we're not that interested. I just don't. I think Bob is a much easier double than Win or Starbucks at these levels. So for that reason, we're just agnostic. Good businesses, they're going up. The question is how much. Tom, you crushed it on VNO. Could you please take a look at HPP? We've looked at HPP a bunch of times. This is a high leverage. There was a little insider buying this week. They're trading like they're going bankrupt, and there's a decent chance they might. But if they don't, you got a $16 stock. So on that basis, I can't get comfort. I can't see all their leases. I can't understand it as clearly as I could have understood Vornado because I don't know the buildings. I don't know the companies that inhabit it. But, it's largely Mag 7. I think big tech stuff. I met one of the directors a couple of years ago, and he was pitching me on it at 15, and now it's 286. So I didn't bite at 15. I'm not really interested in this one. It's too much. It's high risk, high reward, but there's too much in the risk part, and I don't need to. Rule number 1 is don't lose money. Rule number 2 is don't forget rule number 1. I don't care if it takes me 3 years if I've got a sure thing. If I've got a gamble thing for like 3 up, 1 down, that's a trader's game, and that's not what we do. Sarah Wells asks, what's your birthday, Tom? Well, it is an Ask Me Anything question. Anything equals that. It's July 22nd. Thanks for tuning in. Chris Henderson asks, can you take a look at a line if it's your healthcare theme? We've covered this one a few times. The financials look great. I just don't think there's enough. I think their moat has been attacked. The stock has been dead money for 7-8 years. And I think that that's why I've never gotten involved. Cash flow peaked 4 years ago, continues to decline. I don't like it. It's cheap, it's a good business, but it seems to be deteriorating. I think the moat has been breached, and for that reason, I'm not that interested, even though I could be wrong. I don't have FOMO gene. I just try to bet on sure things as much as I can. Digital Bridge, DBRG. Sector is super hot. Well, cash flows are going down along with the price. Let's see, DBRG. Digital infrastructure, data centers, cell tower. I hate buying flavor of the week stuff. I had another guy I played golf with this week pitch me on another one of these things, and not my thing. Let's just see what the financials are doing anyway. My guess is it'll be like the other one where management keeps diluting everyone. Yeah, share count's gone from 118 million up to 160 in about 2 years. So these are scumbags, by the way. This is what a scumbag management looks like. It just keeps deteriorating because they keep diluting, raising capital, paying themselves big money. Not interested. Don't like promoter. Don't like that whole thing. Philippe, Andrew, Pinkos, thoughts on Ambev? I think I'd rather do... I mean, this is another one that's been dead money for 10 years, so you can't even blame it on COVID and GLP-1s. I know it's probably got a high dividend yield and everything. It's not for me. This thing is... I'd rather buy Diageo, best in class, deal with the tariff risk, or even Brown-Forman, and deal with the higher margin spirits. There's nothing not to love about the financials of this business, but it just does nothing. So I think the other way to think about this one is this would be a good play on a good Brazil play. Let me see what the balance sheet looks like. I can accept 2 or 3 years of dead money for 1 or 2 positions out of 10 to 12. I can't accept 10 years. I know Munger did it on BYD and then got a 10 or 20 bagger in a year, but let's see, tons of cash, not a lot of debt. Look, I can't find anything wrong with it, my man, but see what they're doing to the share count. Pretty static. What is this, a 5% dividend yield? Yeah, 5.75. So this is like an annuity, 85% payout ratio. So it just exists for the purpose of the dividend. Look, I have nothing wrong with it. I just don't see an imminent catalyst for this thing to be a beast. So, all right, next guy is Brian McLean. Mattel. Okay. Brian wants to be a client by the time he's 40. You will be if you learn the process. Let's see. Mattel. Mattel is just, my kids don't even have toys. Everything's on the iPad. So yeah, they're moving into the entertainment business and all that stuff. I just don't like this business. It just chronically sucks. I mean, if you're going to buy one of the toy companies, you buy Hasbro, but they're just, I wouldn't want to buy it here. They're just trading vehicles. I don't like them. I like them as much as I like mining stocks. Thoughts on Oxy? We cover this every single week because Buffett buys 5 more shares. Everyone wants to buy it. He bought it here. Okay, he bought it at the end of 2019. He got a warrant deal because it helped him finance this thing. Then the stock collapsed 90%. So he's been buying it. There are going to be less energy companies. They're going to consolidate. So he's betting on the consolidation. He also had a ton of warrants that he's exercising, which confuses everyone as to whether they're real buys or not. It's okay. Go back to the podcast in 2020 and we were jumping around like a hyena, like we are about some of the China stocks now. When we were buying ExxonMobil in the low 30s and Wells Fargo at 25, we buy down here. Up here, there's no asymmetry. Like it's not going to 150 in a week. So if you want something that's a little better than a bond that's going to pay a dividend and it might double in 5 years, great. I think that's what I'm not seeing in energy, which is why I'm not getting excited, which is why we're in Comstock, which we've already gotten more than a double, and we're probably going to get another multi-bagger from that because there's asymmetry. I'm not seeing that in a lot of these energy stocks like we saw it in 2020 when we were jumping up like a hyena to buy everything when oil went negative. So for me, it's a pass. It's just blah. Jay Apt, please take a look at Carvana. No interest. I mean, this is so they're interested because it had a monster pullback of 15%. The thing's up from $3 to $268, and now you want to buy it? Hard pass. I mean, they've got a nice niche business. It's probably okay. It's not doubling from here anytime soon. So for me, it's a big pass. Zara Bassem, PGNY. Let's take a look at that, Zara. Oh, that's interesting. Let's take a look. I'm guessing it's going to be some type of biotech, which I'm going to say I have no edge, but it does look like it's ready to rock and roll. Benefits management, fertility, and family building benefits. This is a biotech, which I have no edge on. So there's probably not going to be any value in doing financial analysis. Let's just see how long they're going to stay solvent for before they have the miracle breakthrough. They raised $371 million of cash, and they got no debt. So they're going to live another day. How much did they dilute the owners with that raise? They took the share count from 5.7 million shares to 100 million shares. No, no. I mean, the problem is when you get this thing up to $25, they're going to raise another $500 million and dump it on your head and drive it back down to 2. I hate promotes like this. I think it looks like it wants to work, but let's just see if they have any revenue. This is the speculative stuff that gets people in a lot of trouble. And sometimes they get lucky. The worst part about it is they get lucky and then they take all of it and they go into another one thinking that their luck's going to continue, and they always give it back to the casino. All right, so they have revenues growing. Do they have any cash flow? Yeah, it's starting to generate cash. All right, look. What can I tell you, Zara? I mean, you really better understand the damn product and understand what is the mode. Is there a patent on it? What does it, who does it compete with? Who can knock them off? Can generics, do a biosimilar? Fertility and family building benefit solution. Fertility solution includes differentiated benefits plan design, concierge member style support. Yeah, so in 2015 they changed their name, so it probably went bankrupt, and then they raised new money and they're back in. It looks like it wants to go, but this is a trade. You got to understand the product. It's not what we do. I'm looking at it. It's like, it's interesting, but I just know they're going to dump another $100 million shares on your head the minute this thing goes to 20, because that's what these type of guys do. So, Aaron, Seth, thoughts on XMAG, S&P 500, excluding the Magnificent Seven? Yeah, why not? AIoT. So it's gone from $1 to $6. No. Give me these things before they take off, not after they just had multi-baggers. AIoT. Power Fleet. What do they do? Negative free cash. No, I'm not interested. I like your first one, though. Chris Patterson. Thank you for all your book recommendations over the year. Can you take a look at Celanese? I like Celanese. It's one of these materials companies that is beaten down. Haven't done anything with it yet. Don't know if I have space to do anything with it yet, but I think over the next few years it'll be okay, and I think it's interesting. On to the next, and we've covered that a few times, Chris. Tim O'Connell, Celsius Holdings, we've covered that a million times. I think it's probably okay. There's some legal issue you got to get comfortable with, but probably okay at these levels. Jimmy Jones, thoughts on investing in Brazil? When do you think it should? When Lula dies and he falls down the stairs again and they get a conservative in, it's going to go bonkers, but it's not there yet. But, yeah, it's like waiting for Godot. I just don't see any real asymmetry without massive risk in Brazil. I think China's the better play right now. But, yeah, I think Brazil's going to work over the next few years as well. With that said, I want to thank everyone for tuning in. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.